Today we are analyzing General Dynamics Corporation, ticker GD, and I am excited because this is a defense company, and over the next few minutes we'll be discussing both the valuation of this company and its business quality, and defense is one of my most exciting industries that I am looking at today. There's a market cap of $63.1 billion, enterprise value of $71 billion, so you see about $8 billion in net debt on this business, which is, a little over 10 to 15% of the overall enterprise value. Not a small amount of the overall amount. So they operate as an aerospace and defense company worldwide, but of course, being based in the United States, they're going to primarily serve the United States and its allies. Has four segments: aerospace, marine systems, combat system technology. So aerospace, of course, is talking about producing business jets and aircraft maintenance, repair, management, and other systems. Marine builds nuclear-powered submarines, surface combatants, and auxiliary ships to the U.S. Navy, and Jones Act ship for commercial customers. And the combat segment manufactures land combat solutions like wheeled and combat vehicles, Stryker manned combat vehicles, weapon systems, munitions, payloads. This is basically one of the prime defense contractors in the United States. And the technology segment has IT solutions, mission support services like communication, computers, command and control mission systems. Overall, generally, this is a prime contractor for the U.S. military, and so their main customer will, of course, be the U.S. military, but they do have some commercial segments, commercial customers. That is something to be aware of as well. So beta of 0.82, that's significant because for an S&P 500 company, the lower the beta is, especially off a baseline of 1, you mean it's going to be about 18% less volatile than the average S&P 500 stock, which tends to be one marker of a relatively high-quality company. And when we go down to the return on invested capital chart, you can clearly see the low volatility in these numbers. And how do I get that? From every year to year, just incremental year, the change in return on invested capital is very, very low. 12.07%, 12%, 13%, 15, 15, 17, 15, 16, 15. Very little change from every year. A lot of flat lines. Those flat lines are very good because it means the business is more predictable. The more predictable the business is, the easier it is for shareholders to assess it, and the easier it is for management to understand and plan. Now, 2012, you had a big drop to negative 2%, but it immediately rebounded to 14%, which makes me think that there was some sort of one-time item. I'm not super concerned in that area. Overall, though, very high quality business here from the numbers we're seeing. They spent the entirety of the last 2 decades besides 2012 both making a profit and earning at least 10% return on invested capital, which is exactly what I want to see for a company that would go onto my watch list. Very high quality business here. Now, I can say it's a high quality business, and yet you have these gross profit margins of 18.5%. So why would that be? As a defense contractor, a lot of your contracts might be cost plus. You might be a sole source for a certain product. If they're making a certain munition or a certain ship, they might be the only producer of that ship in the entire United States, only producer of that munition in the entire United States. So the U.S. government might require them to do a cost plus contract. That means that they can only make a certain margin on their product above the cost of the good. However, you see a very high conversion rate from gross profit margins to EBIT margins, and that's because of how these contracts work. They might live in one sort of margin, but they do want the companies to still make a good return on their capital so that they continue to produce the munitions needed by the U.S. government. But overall, these are my prime markers right here of the high quality business. 14% return on invested capital, 22% return on equity. Very strong numbers that would make me attracted to being an owner in this business. The first thing that I see that would make me less attractive is their growth rates. 2.4% revenue growth rate, and you can quickly see they grew from about $30.9 billion to $39 billion. That's about growing about 30% over the course of a decade. It's not that much. I'd really like more growth, and you can see that they didn't grow that fast on free cash flow either. They grew a little bit faster at 4.8%, and we see no number here for EPS because of probably some sort of disturbance in the calculation. But if we just do a mental calculation ourselves, we see they had $6.67 at 2013, $12.19 in 2022. So you see almost doubling over the course of a decade, which is talking about a 6 to 7% growth in the EPS rate. 6 to 7% growth is not bad. It's okay. But part of the problem for this company appears to be that they're not growing very quickly. They've kind of met there's not a lot of addressable market that they don't already have. The defense industry is great for returning reliable returns. You don't have a lot of competition once you have a business, but you can really struggle to grow. And I think that's where we're going to run into a problem here on this one is there's just a limit to the overall amount of growth. Your revenue growth is really driven by growth in the programs, growth in the military spending, growth in the defense budget for the overall country, because you can't really steal business from competitors. So even though it's a good business because your business can't be stolen from you, it's also hard to steal business from competitors. And so that can be a negative impact on them there. Now, the PE ratio is quite reasonable. PE of 18 means you're getting an earnings yield of about 5.5% to start. You combine that with EPS growth of about 6 to 7%, you can easily see how you can start to get a double-digit return on this investment, especially when we go down here to the dividend, which we can see, well, in 2012, they kind of cut it down to $3.78. 2021, they had $5. So you can see, 2 to 4%, 2 to 3% yield there. So you get 2 to 3% yield there, you get about 6-7% growth. You have some other return in that there, and you're right at that 9-10% range for returns as shareholders. Very respectable, solid defensive business in a defense industry. But one of the things that's really interesting to me about the defense industry right now is some of the stuff going on a macro level with the war in Ukraine, between Ukraine and Russia. But really, with that war, the U.S. government has been providing a lot of munitions and other tools, which may or may not be provided by General Dynamics. In general, though, that is something that could be a long-term trend if the overall production rate has to be increased by U.S. contractors. Whether the U.S. is involved in the war or not, they may end up selling more to their allies in Europe. They may end up producing more munitions at home to have higher stockpiles. Just the possibility of a future Cold War with buildups in munitions can really benefit the domestic defense industry. So it's something to think about. With the 10-year CAGRs here, it's not super, super attractive. But if the key would be is if the future could actually be better growth than the past, that would be something that would be a really good thing you'd want to have for a company like this that's earning good returns on its capital. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. But we're going to dive into the income statement, balance sheet, and cash flow statement next, which I think you will find quite valuable. So one of the things that's really interesting is the SG&A grew from $2 billion to $2.4 billion. Why is this important? The SG&A grew slower than your revenue growth, which is very important. You grew your revenue at 30%, you grew your SG&A at 20%. That means that you're able to get a little bit of operating leverage down below that so that you can grow your net income number just a little bit faster. And that's why you see your revenue growing here 30%, but you actually increased your net income 50%. That boost is very important. Now, how did they almost double their EPS? It's clear that it is now share buybacks. You went from 353 million shares outstanding to 278. So they bought back about 30% of their shares. So all of these little operating leverage, all of these little leverages of reducing your share count, maintaining good discipline on the SG&A is how you can turn 2% revenue growth into 7% EPS growth. That extra 4 to 5% there is key for getting a strong return as a shareholder. So you want to see them continuing to allocate their capital this way because it's what's allowed this EPS to grow so much faster than the underlying net income and size of the business. The size of the business is really limited by the overall military size, and so that's something to be aware of. Especially, let's go back to this income statement. You think about the revenue here is $39 billion, and the overall defense budget, I think, is something like $800 billion. So you're on the range of 5% of the overall defense budget of the United States may be going to General Dynamics. Now, of course, I'm excluding all the commercial business and everything like that. But if the end customer is the U.S. government, you're talking about your revenue is about 5% of the overall military cost. That's a significant amount. It does mean that you have some limitations on your overall future growth. Now, balance sheet. Key thing you want to see here is there was an acquisition in 2017 to 2018. Was there big growth in their income statement there? Yeah, so you did see it kind of go up, good 20% in that jump. So that's good to see. But what it did on their balance sheet was also similar. You went up by about 30%, and that's because of this big goodwill jump. So you added about $400 million in PP&E, but you added $8 billion in goodwill, and that's causing some of that downstream in your overall return on invested capital. We can see that also matches up well here, that your return on invested capital declined a bit once you started adding that goodwill to the balance sheet. PP&E is $5.9 billion. If we compare that $5.9 billion. You add your inventories, you're at a $12 billion range. Let's go to the income statement. You're still earning a solid 25% return on your net tangible assets, which is quite good there overall. So yes, you have lower returns being reported, but again, that includes this $20 billion in goodwill, which I don't really worry about. Although it is important to understand as a shareholder that's passed, because that's showing you the impact of the overall acquisition strategies of the management. So what this goodwill tells you is about the return on management's decision. What the PP&E tells you is the return on the underlying business. Both are very important for the future in terms of understanding how effective this company is at turning their assets into cash. So let's look at long-term debt. It looks like they took on debt for that acquisition, but they've paid back about $2 billion of it over the last 4 years. That's good to see. You're at $9.2 billion. You actually have between short-term debt of $1.2 billion, $9 billion here. You're running about a little over $10 billion in debt against $12 billion in tangible assets. That's a reasonable balance. And it also means that you're using that debt to get that little bit higher return on capital, because you see here you're going from that 14% return on invested capital to 22% return on equity. That debt is really supercharging the return on equity for shareholders, because it means that you're able to use cheaper debt than the cost of actually using shares to run this business. Likewise, you can see that they are making buybacks each and every year, which is something I always really like to see. They're also paying dividends each and every year, which is what I like to see. You can see the very high amount of cash flow from operations is substantially outpacing their PP&E spending, and their PP&E spending is kind of right in line with the depreciation. That means that they're kind of spending at a sustainable rate. It's neither much higher or much lower, which would require a deeper analysis, but we're spending right in line with what we're getting there. You can also see that even though they made an acquisition in 2018 for $10 billion, because they were able to take on that $8.4 billion in debt, they didn't have to dilute that year. They were actually able to continue to buy back shares, which is a very good sign when a business can use its own cash generation and the ability to support debt in order to make those acquisitions. I don't like seeing acquisitions as much when they have to leverage up, but they have to dilute you in order to do so. This case, they were able to continue to pay dividends. They were able to pay a growing dividend in the future years. They did cut back those buybacks for 2 years for some of that debt pay down, but that's perfectly acceptable to me in order to then now they can get back to buying back shares. I really like the capital allocation here. I really like the business model. This is exactly the type of business that if I didn't already have a significant amount of my net worth in defense industry at the moment, would be very attractive, because it's the type of business that's very safe. One of the things that the U.S. government certainly does is they spend a lot of money on defense, and there's kind of like a bipartisan consensus on defense spending. Now, there's certainly some disagreements about that, but I'm not going to go into the politics of it. The main thing is just that defense spending is clearly part of the culture of the United States, and there's always going to be some need for it. The downside is there is concern about the growth in that spending over time, so you do have a limit on your overall revenue growth rate. This one item right here is what would stop it going on my watch list. If everything else here was the same and this was 10%, it'd be on my watch list immediately. But it can't be 10% because it's already so big. It's one of the prime defense contractors in the United States, and I believe there's only 5 or 6 of those in the whole country combined. They have tons of subcontractors, but I'm invested in a subcontractor because I think they have a bigger ability to grow. These prime contractors, though, are very stable. You see it here. This is a high quality business. This is a very reasonable price for this business. You have a clear path to double-digit returns as a shareholder in this business, and potentially even better if there is a tailwind that comes about either from the war in Ukraine or other wars breaking out, or simply not even wars, but just build up in defense spending by European allies and NATO. That can really drive growth for a business like this. So if that's something that you're looking for, it could be really attractive. But again, won't go on my watch list simply because the revenue growth is too slow, which is a commonality between a lot of these prime contractors. Thank you for listening, though. And I would like to encourage you to become a subscriber. If you want to see the companies that did make my watch list, I have the playlist link here at the top of the video. It's going to be popping up here shortly, and I hope you will check out that playlist. If you would like to learn how to use software like this, quickfs.net, the link is my first link in the description below is the link to quickfs.net. That is my affiliate link. I encourage you to sign up using that link. It's a great way to support the channel. Thank you for listening. Until next time, stop paying fees, start building wealth.